volatility in developed equity markets has declined to the lowest levels we have seen in decades. In the US options market, the VIX index reached its second lowest level ever, and year to date had averaged a level at slightly below 12%. This should be compared to a long-run average level of more than 19% since the financial crisis. Indeed, in the past 20 years, the VIX closed at levels lower than 10% for only 16 days, 12 of which occurred in 2017. Given this index is widely, if incorrectly, seen as the investor fear gauge, these dynamics are seen by many as a warning sign of a lack of investor caution. In the popular press, it is widely attributed with predictive ability, and the low current levels of the VIX are presented as a harbinger of doom. In our own research conversations, we frequently hear of warnings of dangerous levels of investor complacency in terms of pricing financial assets and an increased risk of significant correction in equity markets and other risk assets. Many people see similarities with the run-up to the Lehman default in 2008 and the crash that subsequently followed. Well, we believe the truth is different and much simpler. The VIX index and low equity volatility more generally reflect a generally benign macro environment, improved corporate earnings and a lack of economic surprises. Other financial markets, such as government bonds or currencies, also seem calm compared to history and relative to commonly perceived geopolitical uncertainty. But by and large, these calm markets similarly reflect improved global growth and a sense of relative stability. This benign environment directly impacts price volatility. Markets are less focused on common macro factors and more focused on the idiosyncrasies that affect individual markets and financial instruments. As a result, for example in equities markets, a significant driver of low observed volatility is a decrease in the correlations between assets, stocks and sectors within markets. These low correlations between assets, between stocks, sectors and different asset classes are driven by a high level of dispersion in investor views about the current and future prospects for individual assets, rather than markets as a whole. They reflect a focus on alpha generation from instrument selection, rather than broader exposure timing. This constitutes a striking break with the persistently high correlations we observed after the global credit crisis. This period was often a time of uniformly risk-on, risk-off trading, which resulted in a focus on beta timing. So maybe perhaps we're seeing a signal that suggests a normalization to pre-crisis levels, an environment that might benefit actively managed portfolios which can position themselves to take advantage of increased dispersion in valuations and investor views. While price uncertainty could certainly rise to higher levels from here. In fact, it undoubtedly will at some point. The question is, as always, how and when rather than if. But rather than worrying about volatility per se, which really is a symptom, not a cause of anything deeper, investors are better served by directly considering the implications of potential risk catalysts for future investment outcomes. How best to diversify their portfolios accordingly. Some gradual normalization of volatility nearer to average long-term levels is likely to happen, even in the absence of more abrupt catalysts for steeper risk increases. For volatility to rise much more structurally, we need to see developments that alter the expected path of the global economy. Some of the known macro risk catalysts that could lead to this abrupt transition to a higher volatility regime include the risk of major government or central bank errors, perhaps in the US, China or Europe, or other geopolitical events, such as the possibility of a military conflict related to North Korea. In addition to these macro events, valuations in many asset classes seem stretched by standard measures. Equity price to earnings ratios are high, especially in the US. Credit spreads and bond yields are low globally. Leverage in developed, but also emerging market economies do not seem overly alarming at the moment, But there are some country concerns, say China or consumer credit, which could become a concern if interest rates spiked aggressively or the dollar moved substantially. As always, the best preparation for these known and unknown risks is to think carefully about portfolio construction.